Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Jason Harris. Thanks for being on the show, Jason.
Hey, thanks so much, Whitney. Glad to be here.
Jason built and controls $50 million in a real estate portfolio. Comes from a financial advising background, which has translated into a well-rounded outlook of all investment types. He founded an investment firm, founded a Harris Investment Group, a brokerage and property management team, Harris Real Estate Group, and a training program, Creative Gains, to help other investors get into real estate in some way and achieve better and higher returns. Jason, thank you again for your time today and being on the show. Tell us a little more about how you went from financial advising to the real estate syndication business.
The real story, I guess, starts that I didn't know how to make enough money in real estate to begin, but that was always my passion. And so I wanted to have a more dependable, reliable income to start out my family. And so I did real estate on the side and was a financial advisor. Well, I guess you should say I was a financial advisor by day and a real estate investor by night, so to speak, until I knew enough and understood enough to make a living through real estate alone. And so I think real estate's always been really the passion, but bought my first fourplex in 2010 while I was in college, lived in one unit, rented out the other three with an FHA loan, about 4% down, and couldn't believe how much that helped our family finances each month by not having to pay a mortgage. And so it really just got my wheels spinning as far as what I could do to try to acquire more and more. And so as I gained experience and learned how to acquire property faster and sooner and without money and my own money, I suppose, it made it a lot easier to grow our portfolio and get to a point where real estate could be my full-time career. So that's where I am today and glad to be here.
Yeah. So you bought a fourplex while in college, but I hear you say it supported your family. So you already had a family at that time as well.
Yes. Well, it's just my wife and I guess, at the time, but we had our first little boy while we lived in that fourplex. And to be honest, I was making about as much as I had a part-time job that paid me pretty well, but I worked hard on that job. But the rent income from the other three units was more than what I was making at my job. And so all I had to do was show up on the first of the month, collect rent, and that was far easier than trying to go get a raise from my boss at work. And so it just made me realize how easy it was to make money if you control and own real estate. And so it just made it where it didn't really matter what I did for a career as long as it helped me get more and more real estate. And that was kind of my goal. And so it took me 2 or 3 years to get my next property until I learned I don't have to save up my down payment each time to buy real estate. There's other more creative ways to grow faster.
Wow. Okay. So, let's I guess take us through your path to syndication just quickly. But I know you were a financial advisor for a number of years, and then you moved into real estate full time, right? And so how did you build the business to the point where you could move into it full time?
Yeah, I was a financial advisor from 2012 to 2018, essentially, and could have and should have maybe left sooner than that. However, I started syndicating more in 2015. I think I had 8 or 10 units at the time. I was pretty good at finding deals, and I just didn't have enough money to do all the deals. So started to look to family first, which is the ones who may trust you the most in the beginning, until I had enough of a track record of proven success of doing it well, where others looked at what I was doing and growing and wanted to be a part of it. And so for the last 5 years, I've been doing a lot of JV structured partnerships where I'd go find the deal, negotiate it, and find the capital to make a project happen. And so our team then would oversee the value add of that. And it got to a point where Edward Jones, my day job income, was far less than all the other income that we were making through real estate. So it was easier for me to just walk away and dedicate my time to real estate full time.
Hard to argue with that, right?
Yes, yeah. I'm also, though, grateful for that experience. I think it helped me learn how to talk to investors and understand the risk reward and explaining things in a way that can help them, know what they're taking on in way of the real estate and how it can complement other assets and their retirement accounts that they also may be trying to grow and do well with. So.
I had somebody from Edward Jones reach out to me or try to get me to become a financial advisor. It's been quite a few years ago now, but and at that time I halfway considered it. But anyway, I'm glad that didn't work out.
It was a good career. I was happy to do it, but I love what I do now.
Yeah, so let's jump into maybe a recent deal. I know you're really good at deal structuring and negotiating and some financing, making deals work and making it work for each part of the deal, right? Whether it's seller, the buyer, and everybody in between. So is there a recent deal that we could just highlight and talk through a little bit?
Yeah. I'd like to share one that I closed in August of 2019, not almost a year ago, I guess now. I want to point out, this is kind of interesting. We just offered to do a real estate event night at Outback, where I just came and talked about real estate and different ways that you can grow your own portfolio, and had a gentleman thereafter who wanted to go to breakfast and learn more. And he's the one who ended up partnering with me on this deal in August. It was a 28 unit in South Ogden by Weber State. But interestingly enough, he had sold a business and came into a pretty good windfall of cash, but wanted to find someone who could help him get into real estate and knew what they were doing and understood the market. So just a simple invite people to dinner and teach them something turned into a really good partnership, where we've done 3 deals at this point with a lot more promise of deals to come. So interestingly enough, I found this property on the MLS, and I actually scrubbed the MLS quite a bit. We do a lot of off-market transactions as well, but this one in particular, I felt like had good upside opportunity. Their rent rates were quite low, and it had some doctors actually who owned it, who were obviously smart individuals, but don't understand maybe the market and what the rent demand was. So
why had it not sold already?
It had gone through a few different brokers who were having trouble working out who was taking the listing. I don't understand maybe why it hadn't worked out. I think they maybe weren't doing a great job of showing what the upside capability was. The rent rates were probably in the low 700s. Actually, there were some in the 500s, but most of their rents were 700, 710. Average rents were maybe about 620 between the whole apartment complex there. So if you looked at it from a cap rate perspective only, it didn't show very well for their asking price. But if you knew what comps were in the area, both from comparable analysis and also potential rent, you could see that there was plenty of upside potential. And so that's what excited me. But looking at the operations alone probably would have scared a few off, knowing that the purchase price wasn't justified with the current in-place rents.
Okay. All right. So you got the 28 unit or you found it, and keep going.
So yeah, we actually put the 20 unit under contract first for 1.9 million and had the sellers actually cover our closing cost. And then about 3 weeks later, a 8-plex came on the market that was really close by this asset. And we found out from our commercial lender that they would allow us to get one loan between the two and operate it like it was one together. And so we were able to get it together as a 28-plex, one commercial loan, and have the seller cover closing cost. So I paid $2.7 million for the 28 units. The average cost per unit at the time in the market I saw was about $115,000 to $120,000. But these, obviously, it was about $96,000, $98,000 per unit. So I knew I was getting it for a pretty good price. An added bonus, I suppose, is my wife's a real estate broker. And so we got the agent commission by purchasing the property. So an extra 3% for closing. So $54,000 at the closing table is a nice head start to the transaction. But anyhow, I knew that with some value add, we went in and painted the exterior, did a 2-tone paint, updated the lighting and the doors and the numbers to try to rebrand the asset to something a lot nicer and newer. These doctors actually did a fairly good job of keeping the inside units in good, clean condition. And so we've renovated 7 units of the 28, so about 25%. And those we took from that $700 average rent range to $1,050 a month. And all the others we were able to get to $925 a month. And that's without doing anything to the interior. So we put it under contract for 2.7. We got a bridge loan where the lender was willing to give us $175,000 of Capex budget. So we didn't have to come up with the improvements from our own capital. And through that Capex budget, we focused on the exterior first, raised the rents. You want to add some value before you should come in and start raising rents on everyone. And so once we had rebranded the asset and made it a lot newer, we only had 6 people, and it started out only 4 that left of the 28 after we gave them the 30-day notice. So we were anticipating having a little bit more than that and had budget set aside to go in and improve the interiors once they moved out. So now at this point, we have $925 per unit on the older units that we haven't renovated, and $1,050 on the interior newer ones that we've renovated, have stabilized the asset. And now we think that we can get it appraised for a little over $4 million in about a year's time. And so we're pretty excited about that deal and how it's come together.
That's significant increase in rent.
Yeah. And yeah, very significantly different. And I think that without doing any Capex at all, $850 was very possible per unit. So the good news is just better management helped us see a big upside in that, but the Capex took it to another level, obviously.
Wow. Okay. So what made you see the value in that though? Because I'm, even from the beginning when we started talking about it, I'm like, how is this property on the MLS,
Sure. I think that they tried to do it off market through the brokerage, and they actually wanted $3.4 million for it. I found out later. And so 2.7, I did negotiate that down. So their ask price was 3.2 between the two, but I was able to get it down to the 2.7 level. And it's maybe just because I caught it at a good time.
I was going to say, what was the key in negotiating that price to lowering it like that?
Well, I showed them comps of smaller units that had sold for a cheaper price per unit. I think that was one way to show them. I didn't think it would appraise for the amount they were asking. I did that from the income approach, obviously showing them a much lower rent rate of what others were selling for the same similar rents. And so utilizing the data, I think, helped significantly more by showing them that.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm, Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. So what about the Capex plan? Like, how did you budget for that? But then also, I'd love to hear a little more about the financing too. It's so creative. You were able to get both of those properties under the same loan. You did a bridge loan. Maybe you could elaborate on that a little bit for the listener that hasn't heard of that before, and what that means, why that was important, even to get the Capex dollars in there as well.
Awesome. Yeah, there's a few things about this that are really helpful, I think, for investors. One thing when it comes to Capex, it's all about ROI and where can I put this money that would give us the best return on investment? So the way I approach and look at it is, if I add storage units to this facility, how much additional rent income and profit could I make by putting those in, and what would be the cost? And so hypothetically, let's just say it would be $1,000 per unit, or $28,000 on a 28 unit like this, but the tenants would be willing to pay $50 a month. That would be $600 a year per unit. And so if you take $600 and divide it by 1,000, which it would cost me, that's a 60% ROI. how many people, Whitney, would like to get a 60% ROI on their money each year? So that's a pretty good return. Well, the other way to go about it is if I renovate an interior unit, and let's just say it cost me $10,000 to make a really nice renovation and improvement, what would the ROI on something like that look like? And so $10,000 would possibly get me a $10.50 a month rent rate. $10.50 from the $700 is a pretty nice pop of $350 more per unit. So times that by 12, that's $4,200 a year. Divided by 10,000, that's a 42% ROI. However, you have to have down period where you're not collecting any rent. And so if it takes 4 weeks perhaps to totally renovate it, and then another week or two to get it filled, that's 6 weeks without any income coming in at all. And so you take that away, which let's just call it $1,000. Really, it's 4,200 minus 1,000, so 3,200 a year more divided by 10 grand. That's a 32% ROI. And so as you look at these different profit centers, Whitney, which one works best first as far as how to spend the money? So for me, the storage units was a good opportunity. I have no downtime of not collecting rents inside, but it's a value add to the tenants that I know that they'll pay for. So that's how I really process it, is what will give me the biggest return on my money first, and then work it down the list from the highest profit return. Because I could do all of them. I just may want to start with the best ones first. And so typically I find exterior improvements are a great way to get the best return because I don't have any downtime of the units not being able to collect rent. It immediately improves the curb appeal and aesthetics of the tenant's home that they're willing to pay more for, so that after, say, 30 days to 45 days of those improvements having been done, I can go back and say we have new owners and new management. In order to improve this asset in a way to make your home nicer, we are going to have to get market rate rents. And with that will come further improvements that we're doing, and I'll list those out. But in order to do so, we need to get these units closer to market rate rent, which we've found to be. And usually that conversation goes a lot better because they see the new owners coming in and already doing a lot to make their home a nicer place. And tenants sometimes thank you for it. They say they knew that their rent was low. Obviously, you get some that are pretty upset, but sure, more times than not, we're able to have those conversations. And they may start out saying that they're going to leave. However, when they start shopping and trying to find something else, they realize we really are asking about what's market. They realize how much cost it would be in order to move. And they realize these new owners really do care and are trying to do good by us. And so they decide to stay. And so I think we did pretty well. Had I had too many leave, we may have asked too much. Had I had no one leave, I didn't ask enough. And so getting 5 to 7, I think, was right around where we would have wanted it to be, so that we could take the additional Capex from the lender to go in and have our team improve those units to see what the higher end of the market rate rent could be at that 1,050 number that we filled them with. And so that was one answer to your question. I guess the other one, the bridge loan, why I like it so much is they vet the deal for the exit of what you believe the stable rent rates will be after you make the improvements, and you give them your business plan of what you plan to do and what you expect that time frame to be. And so this bridge loan was an 80% leverage option where we only had to put 20% down. And furthermore, because the lender paid our closing cost, we really only had to put 20% down. And so it was about $540,000 plus some change. I think it was about $550,000 overall. Maybe that had to do a little bit with some of our due diligence cost, but the partner put up the $550,000. I didn't put a dime into it, with the expectation that he gets all of his money back before we split the equity and cash flow 50-50. And I told him my expectation was to be able to do that in 18 months, even though it was a 2-year bridge loan. And so we're starting that. In fact, actually, he's decided to sell. We're actually going to be selling it instead of refinancing, only because he wants to take our equity and go and do it again in a bigger project. So
nice. Will you all 1031?
In this case, well, yes. Yes, we will. Yeah, we got to justify long-term intent, which I think that we can. So yes, we'll be able to do
Any
that.
other ways that you've been creative about tax sheltering?
Yeah, thanks for bringing that up. As a previous financial advisor, I studied the wealthy often and learned to see different things that they were doing, and had an opportunity to sit in on some pretty advanced tax strategy sessions with some of the affluent families that we represented. And one thing I learned, Whitney, is that the wealthy don't invest in real estate specifically for cash flow alone, which was my main driver. I thought many was their primary reason for investing in real estate. But the number one reason I find that the wealthy invest in real estate is the tax shelter benefits. And so this gentleman who I partnered with on this Ogden deal, for example, he actually had sold a business for a significant amount. And with that came a hefty tax penalty, obviously. And so what I'm finding, Whitney, is that if you're a real estate professional, instead of a passive real estate professional, active versus passive on your tax transcript, you can actually take depreciation loss from your real estate you own and use that depreciation against all income sources, not just passive income alone. And so most people who I talk to are using depreciation on the straight line method to shelter their cash flow from their real estate, and whatever they don't use, it carries forward to the future years. However, in the 2018 Trump tax law, bonus depreciation came into play and allows someone to accelerate the depreciation to get a significantly bigger benefit. On this $2.7 million transaction, we're looking at a little over $1 million in the first year of purchasing it, to take that $1 million against all income. And so my partner on his percentage is taking his piece and using it to shelter some of the income he made from the sale of his business. And that money's now more than $100,000. Well, no, for his, it's about $235,000 tax refund that he's now able to go back and claim. And obviously, if you look at that return just on his 550 that he put up for this, that's already 45% before you even look at cash flow appreciation and principal reduction of her loan. So he will see probably a triple-digit return just in 1 year with the way we're structuring it. And obviously my return with not having any money tied into it is also quite significant. So it's really just my time I'm exchanging.
Wow. Well, that's an awesome opportunity. It looks like you've put yourself into, Jason. None of that happens by accident, I don't think. Yeah, you're definitely very intelligent and have studied this and have done very well on this deal, and I'm sure others also. Tell me though, Jason, what's been the hardest part of this syndication journey for you?
I think the hardest part for most people is capital raising. Deal finding is also right there, so it's hard to say which is which. I think, though, putting in the effort and time to find a deal, knowing there's capital to back it, that's obviously a really hard thing to do. So that's what I'm going to stick with, I guess.
Was that for you? Was that the way it was for you?
Yes. I have been fortunate, though. I think, Whitney, if you can establish yourself as a financially responsible steward of your own money and other people's money, it goes a long way to instill confidence in others to feel confident in your ability to protect their cash, but also do well by it. And so I'm going to say yes, but I think others perhaps have struggled a little bit more maybe than mine has been, where I had a financial advising background where I was already representing people on their other assets. Not that I was prospecting within my own client pool, but it taught me how to understand the needs of clients and what matters to them in way of asset protection and growing their wealth in a way that's comfortable to them. So it is difficult, but if you can prove that you're a smart financial steward and that you care about them succeeding and winning in a mutually beneficial partnership, it makes it a lot easier because they see that you're sincere and that your effort is for both parties to win, because you don't want it to be just one deal. you hope to do a good job the first time so you can repeat that process over and over again. And so I think as people see that and understand that you're capable of overseeing a project to its completion and doing well by them, you'll have plenty of capital partners available for the next one.
How are you prepared? And you can use the same deal if you want, but or advise others to prepare for, say, a potential downturn, kind of like everything's we're experiencing right now.
Absolutely. Well, it starts with the numbers first, I believe. You have to make sure that you're, in this case, my exit would work to have different exit strategies. Our first one was actually to refinance this one, and knowing our numbers could be supported is critical. Meaning, I need to know what the current operations numbers are of the property I'm buying, and I have to feel confident also in my projections of what I think rents can get to, both on the income and what my expenses are going to be both now and when I've stabilized it after making improvements. And so that's one way I think that helps, because that lets me know what my profitability, my NOI or cap rate is thereafter. And second, in a bridge structure, obviously, I have a determined date that I have to make a decision by to sell it or refinance it anyways. So it almost puts you in a more uncomfortable position to make sure that you know how you're going to exit. And so cash obviously helps. Having liquidity and other assets to help yourself if you need to keep the property, but values have dropped. The higher rent rates, which we did achieve, but assuming we weren't able to due to some type of market downturn in the economy, could have made it where we made all these improvements, but weren't able to raise rents even after injecting more capital. And so having a relationship with lenders, making sure that you have a stronger cash position, and knowing that you can operate the property in a higher, with higher performance and higher NOI will, I think, minimize the risk that you take, because I think it's impossible to take it completely off the table.
Sure. What's a way you've recently improved your business that we could apply to ours?
Great question. We are, I'm trying not to be as involved in every aspect of the business and entrusting others to head different aspects of it. And I think that's helped for us to grow and expand in a way that if I have to do everything, can't, because I don't have enough time to do it all. So we've started a prospecting team to find off-market opportunities through mailers and phone calls and text. We use CoStar and some other ways that we have data that we can reach out to landlords. Secondly, I started a brokerage at a property management company. So properties that are in our market here in Utah specifically, we have the ability to manage, and I have some control when we're doing a value add project for our property managers to know what the current operations are and what the future operations we hope to be, so that they can help oversee the project management side as well. And also hiring an asset manager, which kind of acts in the capacity of a project manager as well. Why that's critical is because we have a fiduciary responsibility, I see it as, to perform in a way that helps us achieve the desired outcome and return for our capital partners. And so I know how to do that myself, but having the time to do it is a different question. And so I have an entrusted asset manager who's now looking at each of our projects, who's helping me carry out what we need and keeping contractors on schedule, on time, and letting the property managers know when we need to give 30-day notices, and the leasing agent when we need to be prepared to lease it up, as well as different activities that we can do within the culture and community of that asset to change what the community thinks of it, because we're looking typically at a Class C, Class B community and trying to improve it in the eyes of the community. So we do different activities that can help us, I guess, rebrand through renaming the property and obviously putting money into it so that it looks a lot nicer, so we can possibly attract a different tenant profile. I think that's helping me where I have different aspects of the business that I need to oversee, but I have people in place that can help me do that in a way that I wouldn't be able to do myself alone.
So what's the number one thing that's contributed to your success?
I think being creative and always trying to find a solution to a problem has allowed me to do far more deals than what most people would probably have done with the same opportunities. I love real estate. I love putting deals together. And sometimes things just don't seem to be matching up. But when you are motivated to make a deal happen, I think that you can find opportunities to make something work when maybe others wouldn't. And an example of that, agency financing is a superior financing method that's non-recourse, which means there's no personal guarantee, that allows for interest-only upfront financing, so that maybe the in-place cash flow doesn't make sense to most who are vetting the project through a community credit union or a bigger bank. But with my financing, I'm getting a 3% interest-only loan, and they're looking at it with a 5% 25-year amortization, and it significantly changes what their net cash flow is versus what mine would be. That's one that's pretty easy. It's just getting better financing. And then other opportunities of what's the highest and best use of this property that the current management team or landlord is not using, that immediately that we could change and improve on. And so it's looking for a way to make a project better and not giving up. Sometimes you have to walk away from a deal, but there are times where a deal doesn't make sense initially, but there's some hidden gems and profit centers that maybe some won't take the time to find, or maybe don't know that's there, that helps us take a project on and know that we can make a success out of it.
Great answer. No, I appreciate that. And you have to be creative. If you're an entrepreneur, you have to be creative, right? Especially in real estate.
In so many ways.
Yes. Well, I appreciate you sharing that, Jason. And how do you like to give back?
You know, I'm glad you brought that up, Whitney. Something that's pretty exciting that's new to 2020 is we just started a nonprofit. And so my wife has been doing less in the real estate world and more with the nonprofit and charity. And so Kenwell Foundation is a foundation that we just started. And part of it is for a scholarship money that we are going to do in the name or in honor of my grandma and granddad. But there's also going to be some aspects of teaching children and those who are underserved ways for them to get help, both from food, but also just mindset and education programs that we're trying to implement with our local communities. So that's one thing that we're trying to do a good job by our investors, hopefully make them some good returns, and ask if they'd be willing to take a little sliver of the profits and put to work in a good way. And so that's kind of where our efforts are now.
Wow. Thanks for sharing that. I appreciate you all thinking about giving back in that way and creating that method for investors as well. And appreciate you just being on the show, Jason. You're extremely knowledgeable, obviously, and you've done a great job just sharing with us today and sharing about this opportunity and how you worked with your investor and the financing and negotiating and finding the deal. Very grateful for your time. Tell the listeners how they can get in touch with you and learn more about you.
Thanks, Whitney. Yeah, appreciate you having me. Our office number is 801-900-6889. And the best email would be lisa@harrisinvestmentgroup.com. Our website, obviously, Harris Investment Group or Creative Gains, getcreativegains.com. Either one of those would be fine too.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.